Really quick, while we have the time, Jim, Moffett cuts Roku to sell.
Oh, my God.
Target
I went back to Michael immediately.
You know what they do with Nathan? The report says the estimates are too damn high, is what he writes. We might get a 52-week low on Roku today.
They call Nathanson the assassin. This was an amazing piece, basically saying we're all paying too much for Roku. Don't we realize there's a rapid deceleration? I read this and I said to myself, every time I look at Roku, I want to sell it.
Yeah. You know, there's still questions about the aggregators and who really is going to succeed in aggregating all the streaming services effectively and what that's going to look like. Obviously, Roku's platform has been a very powerful one. They've done a great job in terms of getting paid, basically.
But the deceleration, David, that he outlines, the deceleration that Nathanson outlines is pretty severe.
Yeah, yeah. By the way, on this topic, going to have a chance tomorrow to speak to John Malone, Rutledge at Charter, Tom Rutledge, Greg Maffei, and also we'll talk to the Sirius Satellite CEO as well, Jennifer Witz. All it's Liberty Investor Day, guys, so that'll be interesting. Star-studded cast of CEOs. But on this very, Malone and I talked about this a year ago in terms of Roku and where things stand with the aggregation of all these streaming services, whether you end up with a new bundle in some fashion or other. So Roku plays into that, too.
David, will you please ask him whether he thinks that AT&T is the next great growth company?
Okay, I will. It's funny.
Did you guys hear Bukis this morning on Squawk?
Yeah, I did a bit, yeah. You know, AT&T shares, I mean, you can call whatever you want, the stub there, but Discovery shares have actually moved up a bit of late since the earnings report, still down for the year. But, Jim, AT&T shares down 14% this year. There's still real questions about the wireless business, about their overbuilding strategy when it comes to fiber, I guess. It's been interesting to watch. Now, none of them have done well. Verizon, AT&T, and T-Mobile have all had rough years because of the concept that they are simply going to be competing not just with each other, but with Comcast and Charter as well when it comes to wireless.
Meanwhile, Netflix, guys, 700. I think that's an all-time high. B of A this morning, Jim, they're going to start publishing more discrete data on viewing in terms of hours. They announced that yesterday. B of A wonders this morning if that's a precursor to that long-awaited ad-supported option, which Reed Hastings has said he'd never do.
I'm thinking that we really have to start doing, I'm going to do it tonight, maybe with Investment Club, the two classes of stock. There's the classes of stock that are valued, say, on earnings per share, and therefore are pathetic. And then there are the ones that are valued on concepts. I mean, yes, I feel like when I hear Netflix, what I think of 4, 5, 6. I have a T-shirt, by the way, that says 4, 5, 6. Thank you to Will on the set. And what I'm saying is that Netflix is just but people refuse to evaluate Netflix, Carl, by any of the standard traditions that we know. By the way, this is different from FANG, where you could argue literally that Meta is not expensive, that Alphabet's not expensive, and Apple's not expensive. But Netflix is trading on views per share, and Lucid is trading on reservations per share. And we have to accept, Carl, that this is the new world. We can't keep fighting it. We fight it. We keep people out of very good stocks, don't we? I think so.
Yeah, you wrote Get Rich Carefully, Jim. We say this all the time. It's your book.
True. Yeah, I know.
But we're looking at big changes.
But we could create a stock. The three of us could create a stock, get some reservations for it, and it could be worth more than Ford.
Reservations.